Last month's currency markets were dictated by the US dollar, euro and sterling as we anticipate who will cut their interest rates first. The Red Sea crisis has intensified as ships not flagged or allied with the US are being targeted, so this is pushing more and more trade around the west coast of Africa, driving up transport costs and therefore having a direct impact on inflation. The US dollar strengthened on the back of a huge non-farm employment release in early February, posting its biggest increase to new employment since February 2023. Average hourly earnings also showed positive signs to workers by increasing 0.6% against the expected 0.3%. It seems likely that the Federal Reserve will be the first major central bank to cut rates. The growth in employment did not boost retail sales, with consumer spending contracting by 0.8%, showing that the increase in earnings is not currently being spent. Despite the strengthening at the start of the month due to the employment release, the US dollar has actually weakened against both sterling and euro as the month has gone on. The main focus for the Eurozone this month has been on any talk from senior ECB members regarding an early interest rate cut. With inflation falling, there's lots of pressure on the ECB to cut rates. However, a divided ECB council could impact an interest rate cut as soon as June. One ECB member said that inflation could flare up again, citing the contraction in manufacturing and services industries. On the other hand, another told media outlets that the time for cutting rates is fast approaching. Movement against sterling has been directed by interest rate talk, with the currency pair trading within a range of 116 and 117. In the UK, we saw the Monetary Policy Committee vote in favour of keeping rates held at 5.25%. Two members voted in favour of further rate increases by 25 basis points, saying worsening inflation is yet to come. However, one member opted to vote for a rate cut, the first to do so since the MPC voted in favour of a cut to a record low back in March 2020. With the release of quarterly GDP data for October to December, the UK economy officially entered a recession with a steeper than expected fall by 0.3%. This was following a fall of 0.1% for Q3 of 2023. So this month's theme surrounding interest rate cuts is likely to continue as we look ahead to March. On the 7th of March, the ECB decide on interest rates. On the 8th of March, the US are hoping to see a further strengthening of the labour market. On the 13th, the UK monthly GDP will be released, and this will be used as an indicator towards the quarterly figure. If by the 14th there's more contraction in US retail sales, this could prompt the Federal Reserve to take action by cutting interest rates. And so on the 20th, the Federal Reserve will make that decision. A day after that, the MPC will make their interest rate decision. We're expecting them to hold at 5.25%.